Hello, this is Anthony Parent of Parent and Parent LLP, irsmedic.com. I'm here to talk to you about qualified business income and the 20% deduction. And this is something that was part of the 2017 Tax Reform Act. And it's a little confusing to understand. And I just want to give you a quick hypothetical of how it works. So it's a 20% deduction on your qualified business income. And that's always an important word with the IRS, qualified. Everything always has to be qualified in order to qualify. So in this case, let's just assume, maybe we'll make a really basic case. Let's assume a taxpayer makes $300,000 in a year, and he's a self-employed civil engineer. And he files jointly with his wife. Well, in this case, the engineer is able to deduct 20% of his profit, okay? So in this case, that would be $60,000. 20% of $300,000 is $60,000. So before we get to any other deductions, right, because he's going to have a standard deduction, or maybe he itemizes, and maybe there's some other things he's able to deduct in there. He's not taxed on the $300,000. He's rather taxed on $240,000. Now, in this case, what that means the effective tax rate that $60,000 is at is 32%. So if there's $60,000 you don't have to pay anymore, ends up to $19,000 savings. That's what it would be. If he didn't have this 20% qualified business income deduction, he'd be paying $19,000 more. Not so bad, right? Now, that's the easiest case. Usually, in a lot of cases, things get a lot more complicated. But let's answer some of the easier questions out there. Like, one of the things that came up when this tax reform was going on, first, Congress was proposing a pass-through rate of 25%. A pass-through rate is what corporations that are taxed where the shareholders pay the tax as opposed to the corporation. That's the rate for that. That's known as your S-corp. They were talking about lowering that rate from the normal ordinary rates that apply to a flat 25% of income. Well, for whatever reasons, it didn't score correctly. They couldn't go with that. So they wanted to come up with something to give a break to the investors, the business owners, to sort of give them a break, incentive to invest more. And this, again, is the Tax Cuts and Jobs Act. So you'll see situations where you're employing more people, or where it's more likely that you'll employ people, where it's likely that you'll create jobs. That's usually where you see the tax breaks kind of come into play. Places where you're not creating jobs, like, say, for instance, if you're working for someone else and you make a high income, you'll see you didn't get much of a tax break at all. So that's really what this entire, the philosophy behind this entire tax reform is, to get people with a lot of money who might be sitting on it, investing in it, and also give a break to the people who have their sweat equity in their business, who do employ people, to give them a break. Now, some problems come up. Our first problem comes up. Is that certain types of trades or businesses aren't entitled to it at certain thresholds. The general rule, though, is if you're married filing joint and you are a sole proprietor, you're a partner in S-corp, or it's even a trust, you get this 20% deduction no matter what. And that's if you're filing joint. If your income goes up, it starts to phase out, and then you lose it entirely if you're in one of these specified service, trades, or business. And here's our second acronym that we need to learn, is SSTB, and that's in addition to our qualified business income of CBI. The SSTB, there's certain types of trades or business. Why Congress decided on this just comes down to sort of how the law is written, who they want to help and who they don't want to help. People they don't want to help are lawyers and accountants. I don't know how much of a fan of that I am. So doctors, lawyers, accountants, performing arts, consultants, financial services, brokerage services, and if you're managing people's money, generally you're going to be limited. If your income goes up over $315,000, you're going to start seeing this qualified business income deduction go away. And that's not really what we want to see. We want to see people be able to take advantage of this wherever they can. The other places where you start seeing this limit out is where you don't have a lot of W-2 income, or there's not a lot of capital invested. And again, what did we say this tax reform was to do? It was to encourage investment. That means, capital goods usually, or employees, one or the other. So if it's something that there's not a lot, you could really see yourself limited out, regardless of your SSTB. Now, some weird carve outs here. Engineers and architects aren't limited like lawyers and doctors are. So I hope you kind of understand that there's like everybody is good up to 315 if you're married. Then after that, certain people fall away. That's really the best way to explain it. Now, what is the highest effective tax rate if you have unlimited QBI income? And there's certain people that will have that, where they're not, because of the way their business is, what it is, and what it's invested in. Their 20% goes on forever. The top effective rate, if you think about this, gets close to 29.8%. So that's a pretty big savings for a lot of people. And I just ran some. Let's just say you had $10 million of QBI income. That's a $2 million deduction, and I have it at that would result in $740,000 saved in taxes thanks to this. So it's if you're making a bit of income, it's really something you want to make sure you don't lose out on if you can. Some other questions people have is, does rental real estate qualify for business for a QBI, right? I mean, that's a pretty good question, because if it doesn't, you might be stuck with some higher rates. In this case, it does. It really does. The key is that you want to make sure that as a landlord, you have more responsibility than just getting a check. If it's something where you're just getting a check, the IRS is saying, well, that's not really a trade or business. That's just you collecting a check. It's sort of passive income. So even though, yes, landlord, rental property is a passive income, there's layers of passivity. There's really passive, then somewhat passive. Somewhat passive is okay. And now there's some other things too. Your real estate investment trust income can also get that 20% deduction. It has its own special rules for QBI, along with qualified cooperative dividends and qualified publicly traded partnership income. So again, I want to recap here. Let's talk about let's get this. Okay, so we have QBI, another acronym, qualified business income deduction. So where do things get complicated? Where do you want to talk to someone about, okay, how can I limit it? How can I limit my loss of the deduction? Okay, so where your income increases, so the times where you really got to think of coming up with a plan to hang on to this, where your income increases and you have an SSTB and you might have some non-SSTB income. So let's just say that you're an attorney and you make some of your income you make as an attorney, but you also own the property to your practice. There you're going to have a mixture of SSTB income and non-SSTB. That's going to complicate things a bit, and you're going to want to get some help to make sure you can get everything in common. Where you have multiple trades and multiple businesses, and some have losses. You just don't get to cherry pick and just apply it to your QBI, to your gains. You also have to factor in your losses there too. Other situations that are kind of interesting is where you have one spouse that has SSTB income and the other spouse does not, but the total income is high. There's some things that we want to do there. Where your income increases, yet your W-2 wages paid are low and or the business isn't capital intensive. You could really lose out on the QBI deduction there, and there's things that we would want to do. What we look to do for our clients, a lot of our clients tend to live far below their means. And that works out well. If you are able to live below what your means are, that means we're able to do some things to keep your adjusted gross income low so that a lot of these deductions stay into place. But the trick is, if you have a lot of income, you have to put it into something that is going to work. You need to strip it out in a way that's legally recognized by the IRS, or you'll create more problems. And I would just say, some of the things that come off the top of my head is sometimes increasing your own what you're going to put away for your retirement can work. That's sort of the simpler way. Then more complex is if you are working for yourself, something you may want to look into, and really for purposes other than tax to lower your taxes, is captive insurance companies. That's another great way to strip out income but put it in a place that the income is working for you. Stripping out income is easy, right? You can just write a check to somebody and it's gone. But you kind of also want to get some value out of your money too. So that's part of a really good strategy. So I would say, here it is. Bottom line, QBI is absolutely a fantastic thing, but to get the full benefits for a lot of people takes some legworks, and that's what we're here to do. Is we help our clients with this. So if you have a question about this, if you want to see how we can help you out, feel free to contact us. info@irsmedic.com, 888-477-4258. Again, this is Anthony Parent of Parent and Parent LLP. Thanks for joining me today. And please subscribe to keep in touch with more of our updates.